Something strange is happening in corporate America right now. The job market, once roaring with record low unemployment and endless hiring, has suddenly flipped. Big companies that spent years fighting for talent are now quietly cutting it. Tech firms, banks, media companies, even manufacturers, all trimming headcount, restructuring, or streamlining in the name of efficiency. But here's the twist. The stock market is rewarding it. Layoffs that would have once spooked investors are now being cheered. Share prices jump, margins improve, and executives get praise for discipline. Welcome to the great job market flip. Can corporate America cut its way to growth? Let's start with what's actually happening. After years of overhiring during the pandemic boom, many companies are reversing course. Tech led the charge, with firms like Google, Meta, and Amazon collectively cutting tens of thousands of roles since 2023. Then Wall Street followed. Goldman Sachs, Morgan Stanley, and Citi all quietly reduced staff. Now the trend is spreading across industries, from logistics and retail to healthcare and manufacturing. In total, U.S. layoffs are up more than 25% year over year, even as unemployment remains low. That's the paradox. The economy looks strong on paper, but inside corporate America, a quiet cost-cutting revolution is underway. Executives call it rebalancing. Investors call it operating leverage. Workers call it what it is, downsizing. But the logic is clear. After 2 years of inflation, higher rates, and rising costs, companies have one surefire way to protect profits: cut people. And Wall Street loves it. When Meta announced layoffs, its stock surged. When Amazon froze hiring, its profits jumped. When Salesforce slashed 10% of its workforce, it hit record margins. It's the new playbook for a new era, one where efficiency beats expansion. The message is simple: grow profits, not payrolls. This isn't just a financial trend, it's a mindset shift. For much of the past decade, growth meant hiring. Startups and corporations alike expanded aggressively, betting that more people meant more output, more innovation, more revenue. But now AI and automation are rewriting that formula. Executives see a future where machines handle repetitive tasks, where software writes code, drafts emails, and manages logistics. So instead of hiring, they're investing in servers, algorithms, and cloud systems that can scale without salaries or health insurance. It's a fundamental pivot from people power to machine power. And that's changing what growth even means. In earnings calls across corporate America, one phrase keeps coming up: doing more with less. Translated, it means boosting productivity without adding headcount. AI tools are making that possible, or at least giving companies the confidence to try. In tech, developers are now using AI copilots to write code faster. In marketing, automation tools are handling content and analytics. In finance and HR, AI is speeding up workflows once bogged down by spreadsheets and paperwork. That's why companies feel emboldened to cut. They believe technology can fill the gap. But here's the catch: cutting too deep can backfire. Morale drops, institutional knowledge disappears, innovation slows. We've seen this movie before, in the early 2000s, after the dot-com bust, and again after 2008. Companies slash staff, stock prices soar, and productivity spikes for a while, until it doesn't. Because in the long run, efficiency can't replace creativity, and innovation doesn't happen on autopilot. Still, in the short term, this strategy is working. Corporate profits are stabilizing. Margins are widening. Investors are thrilled. But beneath the surface, the U.S. labor market is changing in ways that could reshape the economy for years. Job openings are down. The number of people working multiple jobs is rising. White-collar roles, especially in tech, marketing, and operations, are shrinking. At the same time, low-wage jobs in services, hospitality, and healthcare remain in high demand. The result is a split job market, one where frontline workers are still scarce, but office jobs are quietly disappearing. It's the mirror image of what we saw after the pandemic, when companies couldn't hire fast enough. Now they're asking, how lean can we get and still grow? There's also a psychological shift underway. For decades, corporate culture glorified growth. Hiring meant strength, Job cuts meant failure. But now investors are rewarding restraint. The new badge of honor isn't how many people you employ, it's how many you've optimized. And for executives under pressure to hit earnings targets in a high-rate world, cutting has become the easiest path to success. That's why this isn't just a temporary correction. It's a structural change in how businesses operate. Corporate America has discovered a new growth model: smaller, faster, cheaper. But can it last? That's the real question. In the short term, cost-cutting boosts profits. But over time, a company that cuts too much risks hollowing itself out. We're already seeing early warning signs: slower product launches, customer service issues, and fewer big bets on innovation. Because while AI can make work faster, it can't yet replace human creativity, empathy, or vision. And if every company cuts at once, the entire economy can lose momentum. Fewer workers mean less spending. Less spending means lower demand. Lower demand eventually hurts the same companies that are cutting costs today. It's a cycle that looks efficient on paper until it feeds on itself. So can corporate America really cut its way to growth? Maybe for now. The market's rewarding discipline, and CEOs are listening. But the deeper question is whether that discipline becomes addiction, a focus on margins so intense that it starves the very innovation needed for the next wave of growth. Because while trimming fat looks good in the short term, cutting muscle is what kills long-term progress. Corporate America is betting it can walk that tightrope, that it can shrink smarter, automate faster, and still grow stronger. If they're right, we'll see a new kind of economy, one powered by technology, leaner workforces, and relentless efficiency. But if they're wrong, the great job market flip won't just redefine business strategy, it could redefine the American workplace itself. Because in the end, you can cut costs, you can cut headcount, but you can't cut your way to innovation forever.